Warren Buffett is one of the richest men in the world. One of the key components to his multi-billionaire success has been his ability to buy companies with a sustainable competitive advantage. Think Coca-Cola, Moody's, or See's Candy. For this video, we are going to see if we can mimic his success on how to make money by learning how to identify companies with such sustainable competitive advantages. More specifically, we are going to learn how to do this by analyzing stock market companies' financial statements, the income statement, the balance sheet, and the cash flow statement. This is a top 5 takeaways video of Warren Buffett and the Interpretation of Financial Statements, written by Mary Buffett and David Clark. Warren Buffett can't emphasize enough how important it is for an investor to be able to understand these statements. He says that they are the language of business, and even goes as far as saying that if you don't understand them, you have no business investing in individual stocks. But don't worry, digesting financial statements can be a lot of fun. At least Warren Buffett himself thinks so, as he says that, "Other guys read Playboy. I read annual reports." This man has his priorities straight. Takeaway number 1. Consistency is king. Warren Buffett is notorious for saying that the best holding period for an investment is forever. Here's a quick quiz. Which product do you think is more likely to be popular still in 2050? A. Coca-Cola, which has been popular for at least 120 years and has remained basically the same product for the whole duration. B. Snapchat, which has been popular for about 7 years. The answer is quite obvious. When Warren Buffett is looking for investments with a sustainable competitive advantage, he wants to see consistency. Consistency in earnings. Consistent low debt. Consistently growing earnings. Consistently low spending in capital expenditures and R&D. Consistent profitability, etc. To look at the last 10-year period is a good start, but as in the case of Coca-Cola, the longer the company has been proving its durability, the better. Selling the same product for many years, such as Coca-Cola has done, has a great advantage for you as the stock owner. It reduces costs by a lot. It reduces production costs as the need to upgrade machinery decreases. It reduces marketing costs as marketing efforts are cumulative. It reduces costs for research and development. Duh. It lowers the training cost of employees. It reduces the risk of having obsolete inventory. And when costs are reduced by a lot, it means a lot more money in the pockets of shareholders. Not only are the costs reduced in these companies, but you'll be able to experience compound interest tax-free when your holding period is forever, which is something that has made Warren Buffett awfully rich during the last 50 years. Takeaway number 2. What Warren Buffett is looking for in an income statement. To illustrate what Buffett looks for, we will use one of his more recent and largest investments, Apple. First and foremost, I will assume that you know some basics about financial statements. If you don't, head over to my summary of The Interpretation of Financial Statements by Benjamin Graham for some Investing 101. Let's start out by having a look at the bottom line to confirm what we talked about in the previous takeaway. The net earnings of the company has shown great consistency over the last 10 years. Fair enough, it doesn't have the track record of Coca-Cola, and neither are its products as durable, in my opinion. But the iPhone has looked quite similar since its release in 2007. Moreover, the earnings of Apple have grown at a steady pace. Another thing that Warren Buffett wants to see in his investments is a consistent and high gross margin. As a rule of thumb, you'd want to see a margin of 40% plus. We can see that Apple just makes the cut here. It's always interesting to compare with competitors as well. So, as a point of reference, Samsung had a gross margin of 45.7% in 2018, and Huawei had a margin of 38.6%. Having a high gross margin typically says something about the scalability of the business, meaning that the more the company sells, the greater the profitability becomes. This is the trait that you'd want to see in any business that you own. Finally, we want to compare the bottom line to the top line and calculate the net margin. Companies with a durable competitive advantage have higher net margins than their competitors. Apple beats both Samsung and Huawei in this regard. And here's another rule of thumb. A net margin of 20% or higher is typically a very strong result, revealing that we are dealing with a smoothly run business. Takeaway number 3. What Warren Buffett is looking for in the balance sheet. Next up is the balance sheet. Warren Buffett likes to look at a figure called retained earnings. The figure is being added to or withdrawn from each year depending on if the company is reinvesting its net income or not. Buffett typically likes to see a steady growth here, meaning that the business is profitable and that it identifies good reinvesting opportunities. If we look at Berkshire Hathaway's retained earnings, for example, we see a very strong growth during the last decade. Apple doesn't really fulfill the criterion regarding retained earnings, but one must also take into consideration that starting in 2013, Apple began a quite extensive dividends and share repurchase program. We'll get to this in the next takeaway. To measure how efficient a company is using these reinvested earnings, return on equity can typically be used. To calculate this, we must revisit the income statement and compare the net income to the total equity of the company. Apple is showing a lot of strength in this regard, which is partly an effect of distributing so much of the earnings to shareholders, but also a sign of a business with a durable competitive advantage. As a comparison, Samsung and Huawei aren't even half as profitable. In his 1983 shareholder letter, Warren Buffett suggests a somewhat more sophisticated approach towards measuring how efficient a company is using its capital. He suggests that one should calculate the so-called return on net tangible assets. More on this in the essays of Warren Buffett. A third thing to notice is that the exceptional business seldom requires a lot of debt to expand, banks perhaps being the exception. Because usually it can just use the strong cash flow from the business. Therefore, look for businesses with little to no long-term debt. If a company can pay off all its long-term debt with less than 4 years of earnings, it's in quite a good position. Apple clearly fulfills this criterion, and its competitors do too. Takeaway number 4. What Warren Buffett is looking for in a cash flow statement. Finally, the third financial statement that you must dive into is the cash flow statement. A cash flow statement differs from an income statement in that it represents actual ins and outs of money, while the income statement is a measure of financial performance. Yes, I will probably make a video of its own about this in the future. Comment, I want it, down below if you want such a video. For now, it's enough that you know that one important figure is the capital expenditures. This is money being spent on properties, plant, and equipment primarily. Look at what percentage capital expenditures are of net earnings. You want them to be as low as possible. Lower than 25% over a period of time is considered very good, and less than 50% is acceptable. There are exceptions though, such as when a company is making a one-time payment to grow the business. Look at what the company is using the money for. Apple does very well here. In almost every year, they had capital expenses at less than 25%. The same thing can't be said about its competitors. Also, in the cash flow statement, we can see the reasons why the retained earnings from the balance sheet haven't been growing much since 2012. Apple has been distributing a lot of cash to its shareholders. The so-called augmented payout ratio, which includes share buybacks as well as dividends, has been higher than 100% during some years, which basically means that Apple is distributing more money than it earns. Takeaway number 5. When to sell. As I've talked about before, One of Warren Buffett's key concepts on how to invest in stocks successfully is to hold on to your investments forever. Still though, there are 3 instances when you might consider selling your stock. 1. You need more money for an even better investment. At times, perhaps especially in bear markets, there are so many opportunities to go around that you must consider switching from something that is great to something that is exceptional. In 1974, Warren Buffett said this, noting that a lot of stocks were undervalued. "I felt like an oversexed guy in a harem." 2. When a company may lose its competitive advantage. Times are changing. For example, the once monopoly-like characteristics of the local newspapers are now being disrupted by online media. If one of your investments face a risk of this kind, it may be time to cut it loose. 3. During crazy bull markets. Even a fantastic business can be a bad investment if you must acquire it at a crazy price. And likewise, there are times when you can improve your personal finances by selling a fantastic business at such a price, if you are already holding on to one. Mary Buffett and David Clark suggest that at a PE ratio of 40 or higher, you should start consider selling your stocks, even if you believe in the underlying economics of the company. And that's it. A quick summary. When you are looking for a business with a durable competitive advantage, the keyword is consistency. In the income statement, look for consistently growing net earnings and profit margins that consistently beat the competitors. When observing the balance sheet, remember that the superior business has a higher return on capital, that it seldom requires a lot of debt, and that retained earnings typically show a steady growth. In the cash flow statement, you want to make sure that the business is producing money for its shareholders by examining its capital expenditures. Even a fantastic business should be sold if you need money elsewhere, its competitive advantage is at stake, or if the price tag is at a crazy level. There are lots of other takeaways in Warren Buffett and the interpretation of financial statements that I wasn't able to cover in this video. Consider supporting the channel by getting the book from the link down below. Also, I've made a few videos about Warren Buffett's investing strategy before. If you feel like you can't get enough of the Oracle of Omaha, click on my playlist of Warren Buffett books. Cheers!